Hey,
My
Steve, how
guy.
you doing? How you doing, Steve?
Fantastic. Fantastic, man. Fantastic. Excited. Looking forward to a great year. Looking forward to how to navigate and weave and bob through maybe some new taxes, new tax situation. How about yourself, man? How you doing?
Doing well, man. Enjoying the weather. It's a really good day. A lot of changes can't potentially happen during this whole Joe Biden tax reform. So it's very interesting things that could potentially happen. We don't know what's going to happen exactly yet because you still have to go to the Congress and the Senate to him. But based off of what he's been talking about during his election and his tax plan that he gave out during the election, these are his wish plan for how taxes are going to happen. So even without this, we know that tax plans and taxes are going to change after 2025 due to the Trump tax cuts are going to sunset at that period of time. So it's something we definitely need to think about. We know things are going to happen. We're not sure what's going to happen in the Biden administration or afterwards, but we know tax changes are going to happen. And it's a good time to have these conversations and plan accordingly beforehand so you can put together the right structures towards your business, your family, and your investments to make the right decisions for yourself and how to move forward in the future.
Man, and that's that's the right mindset to have. When we're trying to navigate through all this. And real quick, before we get into it, man, I just want to make sure everybody knows who you are. This is Jason Matthews of my Matthews Financial. Has been a great friend, and my financial planner for since like going back to 2010, 2011. We kind of got going in business around the same time during the Great Recession. And so we've been rocking, doing seminars, educational events, networking for this whole time. And so, if you follow me, you've definitely probably seen Jason Matthews before, and you'll be seeing him again. And I want you guys, a lot of times, our audience is real estate people, real estate investors, real estate brokers, and the like. And a lot of times we just get into this tunnel vision where we only just think in real estate. We only just think in real estate. And I think, insurance and paper assets are a very important part of anybody's investment plan. But particularly insurance, we always talk about insurance. I think it's important for you as real estate investors or brokers, agents, professionals to make sure that you have a financial plan, man, that you're working towards. And in one of my videos I did, we talked about an investment plan and starting with the end in mind. So you need to have a financial planner such as Jason as a part of your team, setting that up, and then you have your real estate investment plan, in line with that. And that probably, if you're in real estate, that's going to be the lead activity of what you're doing. But you definitely got to have your financial house. So with that being said, I just want to introduce you properly, bruh. Jason Matthews, Matthews Financial. Why don't you take away, talk a little bit, and then we'll ask some questions. And for you guys who are here, what we will do, we will hold any questions to about 145, 150, address all the questions, and then go from there. So Jason, take it away.
Yeah, definitely. And everybody, my name is Jason Matthews. I'm president CEO Matthews and Financial Insurance Solutions. I've been in the financial service space since 2004. In 2009, during the last Great Recession, when you saw Wachovia closing, Washington Mutual, Lehman Brothers, and all this chaotic, I decided to start off my own firm, Matthews Financial Insurance Solutions. We're part of $1 Million Roundtable, which puts us in the top 1% of financial advisors around the world. Also, the author of the best-selling book, The Age to Self-Reliance. So going into this, I want to talk about first of why why we have or why we're going to potentially see some type of tax increases. And there's threefold. One thing, if you look at our national debt ceiling right now, it has went up drastically, and even the last year it has went up drastically. We had a debt problem in the United States, but has drastically went up since the pandemic. And according to back in November, the national debt was at $27.3 trillion. And a lot of that was the printing because of the CARES Act, the HEROES Act, and other stimulus plans. We're about to approach $28 trillion of it. So the question is, how do we pay for it? At the same time, we know, because we have an aging society, that Medicare and Medicaid is having a lot of financial issues, and also Social Security, which are our two biggest expenditures on the U.S. debt. So because of that, on the federal government level, we know they're going to have to do some tax changes or something before those our biggest budget items are insolvent within the next 10 years. On the state and local level, because the lack of tax increases due to COVID and all, again with the aging society where we have a lot of baby boomers are retiring and they're having pensions and healthcare. You're seeing a lot of cities and cities having financial issues. A big one right here in Oakland right now. We're talking about Oakland has $100 million shortfall where I'm located at. In San Francisco, they're talking about $1 billion shortfall. Chicago having financial issues. So we're going to hear more and more about tax increases. But today we're going to talk about the federal guidelines on what Joe Biden potentially wants. And like Steve, and like the rest of us throughout this country knows that it has to go through the Congress and Senate. The good thing is on Joe Biden's side right now is during these next 2 years, he has a Democratic Congress and Senate. So that could help him out substantially. Now, when I go into this, there's 3 resources I got to talk about the potential tax increases. One is the Tax Foundation. We talked about it. Also, IRS.gov tax reform. And then also on Joe Biden's political website, which was last seen on December 1st as well. So here's what it is for as a summary of everything. So the potential tax increases are going to go after the after-tax high-income earners of people making between $400,000 and $790,000 are going to see the biggest tax increases that we're going to potentially see. The main reason for this increase is going to be due to dividend and capital gains tax rate increases that are almost going to be twofold that exceed over $1 million, as well as changes to the state taxes. So here's a couple big ones that we're going to see. Joe Biden, first and foremost, he talked about he's going to raise ordinary income taxes from 37% for the individuals right now up to 39.6% for federal income taxes. Does not include the state or local governments. That's only going to include ordinary income on the federal level. So it's going to jump from 37% to 39.6% for anybody who has income excessing of $400,000. Currently, if you make you pay 37% in taxes if your income exceeds $529,000. Okay. The second thing that we could potentially want to see is capital gains. Long-term capital gain rates are going to jump from 22% up to 39.6% for taxpayers earning more than $1 million. And they're also, and here's a huge one, especially me, where we specialize in working with people who come across with windfall money usually through an inheritance, a settlement, switch jobs, or just retired. But they're talking about eliminating the step up in basis for capital gains taxes, Steve. I know a lot of which is a huge one, which I assume a lot of I'm assuming a lot of the people on this call who might be investors who plan on passing down wealth to their family is going to be hit with that. I was talking to one of my clients last night, and and their father is in an assistant care facility, and he bought, he'd been having a house that he paid $30,000 for. Now it's worth about $1.3 million in Nevada. And so just off of him just being conservative, being safe, not even being an aggressive investor as on the real estate side, his family, he thought was going to pass down this wealth of $1.3 million, which is going to help out his kids and his grandchildren like he wishes. Instead, they look like they're going to be paying a huge amount towards capital gains. And the question at that point is, for a lot of people is, when they do that transfer upon death, how are you going to have the liquidity to pay those taxes? So right now with capital gains, you could wait until you sell the property, but they're actually talking about eliminating it. So once you transfer the taxes, you're going to have to pay that 39.6% in taxes. So you have $1 million, 39.6 is going to be what? Almost $400,000 of liquidity you're going to need on hand.
Wow. And that's real quick before we go, just talk a little bit about the step up in basis, the way it works now. And I know we're not giving tax advice, but at least your understanding, my understanding, but that is a big part of people's estate plan, and that's a big part of what people, part of the benefits that people get, at least right now. So just talk real quick about the existing step up in basis that folk get.
All right, definitely. So what happens is, let's say you bought a home for $50,000. The day before you die, You sell the property, is worth $1 million for $1 million. You pay taxes, you pay capital gains between the 50,000 and the $1 million. You will pay capital gains on that $950,000 gains that you had over the years. But if you, upon your death, your heirs actually receive that whole $1 million, all tax free, and they don't have to pay any taxes on that transfer of that home into your heirs. They only have to pay any taxes on what they call after the day of death. So let's say that home stays within your family for another 20 years. That home appreciate, or that apartment appreciate from $1 million to $2 million. Your family only has to pay on the gains after you die. Any value that happened while you was living is all tax free. And so right now it's currently at 20%. They're talking about it might jump up to 39.6%. I say that a strategy, a lot of my clients, where we're considering this now, is possibly looking at using some of their funds to use life insurance as liquidity, or making sure they have liquidity on it, but you having life insurance or some type of liquidity to take care of that taxes if it does happen. So it's something you definitely want to consider.
Yeah, absolutely. Well, thanks for breaking that down, just because, step up and pay. A lot of times people just thinking about their property, their business, what they have. But we really got to be thinking about the next generation and setting things up with that in mind. And as you're now continue where you left off, we're talking about the potential, and I guess what they're saying is a removal of that step up in basis. And I guess in order for you to, and tell me if I'm right or wrong, in order for you to get that property, if you will, then you gotta pay that 39 something percentage if that were to if everything was to go through as what we're talking about. Is that kind of what you're saying?
Exactly, correct. And I think
Wow.
that's going to hurt a lot of households that might be real estate heavy, where they might not have the liquidity on hand. If it's like estate taxes now, you have 9 months to come up with that cash. You see this issue for liquidity, even when you talk to people or farmers, where they're heavy property owners, but they don't have the liquid cash on an ongoing basis to pay the estate taxes if they're for the high net worth farmer. So I think this could be an issue for a lot of folks who have done well, bought a home to live that American dream, and want the next generation to take advantage of it. I think it's going to be very tough for them. I think right now what we're going to see is the government is going to look at every single angle to catch up on all this debt and to cover Social Security and Medicare. They can print money, but at a certain point, you cannot just print money. They're going to have to raise revenues, and the easiest way to raise revenue is through tax increases.
Yeah, absolutely. And I think that, so like what you're saying, I mean, the end of the day, when you talk about the debt level and you talk about all these, responsibility that the government has, and then that was all, and you've been saying this for years, by the way, before the pandemic, right? And then the pandemic came, and then now we've added trillions on top of that in a very, very short period of time. At some point in time, we got to pay for it, whether we like it or not. That's why I want to just preface this. We're not talking politics, the same Republican, Democrat. We're talking business and how to deal with this. And the reality is probably going to be some more taxes. So quick question as a follow-up to what we're talking about, this possible elimination of the step up in basis. What do you see as some solutions? Okay, so let's just say, someone has a trust, they got their things together, and they pass down the property. So it's not going through probate, by the way. You want to avoid probate, like the plague or like Corona. But you want to, let's say somebody has their estate in order, and then they want to pass it out. But now they've got these taxes that they didn't have to pay. You mentioned life insurance as a way, of providing some of that liquidity. Are there any other, I don't want to say loopholes, but are there any other strategies, if you will, for people, let's say even if they have a life insurance, they may not have that much of a cash value built up, or I don't know how that ends up working out if they can borrow the death benefit. But what are some ways that they can maybe structure something? Say, I don't have the if it's $1 million property, I don't have 390,000 or 400 G's. What could I then do to, not have to sell the property off?
Yeah, I think your family have to look at one, if we have cash, to look at life insurance and see what might be the credit worthiness of our family, where maybe we know that we're going to have to take out additional loan to pay those taxes out if we don't have the cash on hand. Or the fourth thing is looking at converting some of our 401k plans and IRAs today and moving them over to Roth IRAs, as that's usually a lot of people's biggest asset, and moving over and paying the taxes on the IRA or IRA account, pay the taxes on that today. And then hopefully that'll be enough cash that's tax free where we could pull it out without paying taxes. Because the issue is if we pull it out of your IRA accounts, you're paying taxes on that money as well. So you're paying taxes, pulling out money to pay, you're going to pay tax on the money, pull out, then you're about to pay money as well on those capital gains on that real estate. So you're going to pay astronomical amount of taxes pulling out just to pay these taxes, which you don't want to do.
Yeah. So that's what you're saying, looking at the credit, whether can somebody basically refinance or something, which is
correct.
Put some kind of credit in place, because is it safe to assume that if you cannot come up with this cash, then the only way then to pay it is to sell? Is that or does the property get taken? I mean, I guess what if you can't pay this enormous amount of money, then what then happens, right?
You're probably gonna have to sell the property.
And you know what I mean? And so I hope you guys listen to this, man. I mean, this is important stuff, because we got to start putting some plans in place that if this happens, to deal with it. And there's the whole advocacy piece and talking to your centers, like for instance, real estate. NARAB does a lot of advocacy. National Association of Realtors does a lot of advocacy. And so we know those groups are pushing for real estate. But I mean, I think you got to have a game plan, right, Jason? Like what we're talking about is if and when that happens, because for people, a lot of people don't have trust in their estates. So then when they pass on, it's just chaos, right? But for the people who do actually take a step back and say, we're going to put these properties in the trust, we're going to get some things together, they haven't been thinking that we've been enjoying this step up in basis for quite some time. You know what I mean? And so this is it could be a major deal. So the biggest issue is to put some kind of plan in place for your heirs, if you're the person who has the property, or if you know that this is coming up for you as an heir, to start thinking about it. Because if it's a property you want to keep in the family, you have to do everything you could do in the family. If it's a property that's positive and productive, you have to do that. You know what I mean? And what you're saying, Jason, tell me if I'm right or wrong, like somebody has to pay for that up front instead of, out of the sale. If not, they have to pay it out of the sale. And I wonder if they sold it, could they then do a 1031 exchange to then defer those gains? Is that possible? That not, because that was, tax that was simply due upon the transfer.
It'd be interesting to see if they will allow that to happen, or if that's going to be a strategy. If this portion of Joe Biden plan gets approved, if you're able to do that, what type of loopholes might be available for that?
Well, yeah, I know. We stopped off on the step up, and basically it was important. You got some more things to kind of go over, but just thinking, I'm always trying to think outside the box and figure some solutions out. So, man, continue. I know we got talking about that step up in base. That is a big one, but I know you have some other things to discuss as well.
Oh, definitely. Another one is when we're talking about payroll taxes. This is for your small business owners. When we're talking about some things that they're talking about. One thing they're doing is they're going to lift the cap on the Social Security payroll tax on anybody whose wages are above $400,000. Right now, Social Security is capped off. Right now at the max income this year, $137,000. They're talking about lifting it for anybody who's above $400,000. So that, which means this: you're going to pay additional 6.2 in Social Security tax on anybody who's making excess of $400,000. So what I think was going to happen is the EPS Corp is going to get more and more popular instead of LLC, as people will pay themselves a salary to pay themselves a reasonable salary and get more passed through their K-1s to avoid those payroll paying that additional 6.2 in Social Security tax, especially for small business owners. And really, remember, it's 6.2. And remember, it's 6.2 for the employee and the employer. So if you're a sole prop, you're actually paying 12.4%. Now, with that being said, you're actually going to pay 12.4% if you make over that 400,000. If you're self-employed.
Right. And you're just talking Fed, right? That's not even California, right? Is there a California tax? We got to ask that question.
Right, and that's not including California tax. That's not including the payroll taxes for anybody who makes over 400,000, who has the 1.45% Medicare tax on all their wages, and another 0.9% on payroll taxes. So it is a huge amount of taxes on that.
Well, yeah. So okay, and I picked up on something that you said. You said you think the S corp is going to get real popular, maybe over an LLC, because then you can pay yourself with a salary. Explain that real quick, because I think that you just laced us with a gem right there. With okay, well, if the government comes with this is what they're saying. That maybe we can have another strategy and tactic. Break that down for a minute.
Yeah, so let's say right now you're a sole prop and you're making say 500,000 a year. You're a doctor or a dentist, and you're making $500,000 a year as a sole prop. What I think is going to happen is what you're getting killed on for a lot of those businesses is self-employment tax because you're paying the whole 12.6% in taxes. So what I think the idea structure would be is, hey, I'm going to set up an S corp, and then once you set up an S corp, you give yourself a what they call a reasonable salary. On that S corp, a reasonable salary says on that salary you pay self-employment tax. But another way you could pay yourself is through your pass through or what they call your K1. And when you all income you get from your K1 or through your pass through, you pay no self-employment tax on that. So that money that goes to a K1 or is avoiding that 12.6% in Social Security tax and Medicare tax if you're in that if you're making over that 400 grand. So it's a great strategy, and I think it's going to get more popular if this gets through. Is to use the S corp, give yourself a reasonable salary based off what the IRS says, and your tax advisor, whoever is your CPA, EA, or does your taxes, if it should be 30, 40, or 50% of your annual net income, and you keep that as a salary, keep the rest through your K1. It doesn't mean that you don't touch that money through a K1. You just pay yourself through your K1 back to yourself.
And you're okay. I see what you're saying. I mean, that's the K1 being basically business income, right, or
Correct.
profits, if you will. You know what I mean? If it's real estate and properties, that's essentially passive income, right? So you're saying basically, by doing the S corp route, you can give yourself a salary to essentially knock yourself down under that 400,000, right? And then that way, I mean, you probably got some taxes to pay on the salary, but that may be less than what you would pay over aggregate if you were making profit of more than 400,000. Is that
Correct.
right?
Correct.
Got you. Hey, if you're making 400,000, you know what I mean? That's a good problem to have. I just want to say, and that's why we having this conversation. So hopefully you guys are there or going to get there, and and then we can once you get there, and as you figure, look, more money, more problems, right? That's the theme. And as you have more money, as you make more profits, as you inherit property, as you pass on the property, there's a different set of concerns. And that's what we're attempting to tackle right now, man. So thank you for that, and continue with that. I just want to make sure we hit that because that was a great gem of how you can deal with this. That's probably definitely coming down. If I can look and see if one is going to happen, being that they gave us all this paycheck protection loans, right? They gave us all these paycheck money that is forgivable to an amount. They probably going to then come back and say, well, look, we need some payroll love over here on these taxes. I could definitely see that one going through.
Yeah, definitely, man. And another thing they're talking about as well, when you're talking about payroll, is they're eliminating for those people who make over 400,000. They're capping off your itemized deductions as well. So if you make over 400,000, they're going to cap off what you can have as itemized deductions. So there are going to be less of deductions for that. And a huge one that they're talking about is getting which was part of the Trump tax plan, is they're going to eliminate the 20% qualified business income deduction, or the way you consider the 199A, which a lot of people love. If you was a small business, you automatically got that 20% tax deduction. They're talking about getting rid of that altogether, which is huge, huge. I take advantage of it. You take advantage of it. A lot of small businesses take advantage of that automatic 20% deduction. So let's say you make $100,000 a year. You get a $20,000 deduction, saying now you make 80 grand a year. That's a huge thing. Now that's going to get eliminated. That's crazy that they're talking about eliminating that 20% automatic deduction. And I'm not sure how we can avoid that right now, but it's crazy that they're thinking about getting rid of that 20% deduction.
Well, I mean, yeah, that was I ain't gonna lie, man. I'm hoping they don't I hope they don't push that one through. But hey, it may be a reality. And does that depend on whether you have an S corp or LLC, or does it really matter?
It doesn't really matter.
And it's because I'm doing both structuring some new entities, and I've had S corps, I've had LLCs. You know, they're both good for different reasons, and I think you need to talk to your tax person. You can talk to your attorney when you're setting up these LLCs, but do that with this new tax rundown that may be coming down. So, you know, I hope they don't do that one, Matthews. We need that one. You know, but look, at the end of the day, we know it's coming down. We know this is coming down. So that's what we're just trying to prepare on that tip. But that's a tough one.
Yeah, definitely. Let's move over to corporate taxes. So right now, I know most people don't pay corporate taxes, most Americans, but right now the corporate tax rate is at 21%. There's no AMTs or alternative minimum taxes. What they're talking about is getting rid of increasing corporate taxes from 21 to 28%. And they're implementing a new form of the AMT by requiring corporations that have a financial statement that exceeds over $100 million to pay 15% of its financial statement income, which I think is going to be a huge thing as well.
You said financial statement income, so that means that sounds like gross income, not net. Or are we talking gross income?
Yep, they're talking about gross income. So that's any business who makes over $100 million. I don't. My business doesn't go over 100 million. I'm not sure, but I know there's people out there.
We ain't there yet. We're gonna get there though one day.
We're not there yet. I love it. Yeah, we're not there yet.
We ain't there yet. So hey, but look, okay. Wait a minute. So let's say you got a business. Okay, let's think about somebody, not the top guys, but who's $100 million business, and then we can think about.
Let's talk about some construction companies, some developers. I ain't saying no names, but I know some construction companies and developers who has $100 million worth of receipts right now, or this year.
Yeah.
Let's say 100 million. You know, that's $15 million in taxes.
And you're talking. I think. Listen to what he just said, y'all. Gross. So you know the difference between gross and net. I mean, I might bring in 100 million gross, but I might only net 5. Right? That's just that I got like in real estate business, you know, brokerage, our profit margins are bigger than that. But let's just say like a grocery company, you know, Safeway or something. Say they working on like 3 to 5% margins. So if they bring in 100 M's, they only making 3 to 5. Now they bring in more than 100 M's, but let's just say their profit is $3 to $5 million. So if they're paying 15 million, let's say, and they're only making 3 to 5 million, so they just off the gross. Man, they got to change that to net. But I mean, if it's growth, then they're all of a sudden taking a $10 million loss.
Right.
Right. I mean, is that right?
Yeah.
Am I saying that right?
Yeah, you said you're right, which is crazy. Crazy.
Well, okay. So, you know, I'm not like I feel sorry for the $100 million people, but the difference. This is the thing I have to always break down to folks, especially to real estate. Everybody thinks landlords makes all this money, and some landlords, if they bought right, make a ton of money. But what happens with the gross money that you bring in, you got to then spend it on all these operating expenses, and then you have to spend it on your debt service. And so a lot of times people, like when they buy these properties, they overpaying, buying them at 3 and 4 cap rates. So by the time they pay all their expenses, pay the mortgage, there's really not a lot left over. Now, if you bought your property in 2011, that's probably not the case, right? You're making some money. But if you're most of the taxes that you know, there are like sales taxes based on gross receipts, like City of Oakland business tax based on the gross rents that you bring in, you know, but those are smaller taxes. Most of the big taxes are based on your net profits or your gains, right? What you profited, what you get, not the gross amount. So I mean, I talk about, and you might have said you might already be planning to talk about this, but as we're talking this, I'm thinking, well, how does that affect the stock market? By which I'm not like a stock market guy. I'm not against it. I stay in my lane of what I know in real estate, and I'm more interested in learning about like gold and, you know, silver and other currencies and cryptocurrencies. But a lot of people making money in the stock market right now. A lot of people are all in on the stock market. How does what you just said affects stock market in general?
So here's a couple of things. And when you look at the tax foundation, great question, Steve. They think that the tax plan will reduce the gross domestic product in this measure how much our economy is growing by 1.62% over the long term. They also think So you're going to see the economy slow down. They're saying it's going to drop. We're not
Yeah.
going. It's going to reduce the growth of them. They also think that will lead to about 7.7% less after tax income for the top 1% of taxpayers, and about 1.9% decline in after tax income for all taxpayers on average. That's what the Tax Foundation says. Now, how does it affect the stock market? We don't know. We don't know. A lot of people think it's going to slow down the stock market. A lot of things we think is going to slow down the stock market. But in this crazy world right now, the stock market, nothing's predictable at this point.
The stock market don't seem to make any sort of sense based on any sort of reality. And I'm not a stock market cat at all. But it just don't seem to make sense. It reminds me of 2006 and 2007 in real estate, where you start seeing a bunch of defaults, but yet the prices were still going up and they were still pushing out money. I know a lot of companies have took losses last year. A lot of big companies, a lot of profitable companies also just took losses. Yeah, it's still, the stock market dropped, down to 19,000 something, and then where is it? I don't know where it's at today, but I know it was over 30 at one point, 30,000 again. That's insane. And we're in a global pandemic. So I don't, you know what I mean? I don't, like I said, I'm not a stock market cat. It just seems uncanny. But when you start talking about companies, those are hard dollar costs that those companies have to pay. And now you mentioned something else. You said that the corporate tax rate's at 21%, right? And it may go back up to 28% was where it was at before the Trump tax cut. Is that right?
Correct.
Okay, so they're basically saying, okay, we're going back to what it was before. Is that what they said on that one?
Correct. They're going back to where it was before. We're going back to where before. And the whole point of the Trump tax plan was we want to simplify the tax code, which it was actually got more confusing. We want to simplify the tax code. And hopefully, when we talk about corporations, we're talking about C Corps, which is a very small percentage of businesses, usually bigger corporations. And we want these companies like Apple, Google, Amazon, all these companies got all this offshore money and bring it back to the States by telling them, hey, we got low tax rates. This is the time you should come back and bring all that money that's offshore in these different countries back into the United States. If not, a lot of them probably going to keep the money off of the banks of America and keep sending it to the Cayman Islands, and where else they have crazy tax laws and provisions for them.
Cryptocurrencies, right? I don't know. Elon Musk put all that money in the Bitcoin. I don't know. Is he making an investment, or he just trying to make sure he has some of his money decentralized?
Who knows? The whole Tesla thing, what's crazy is the whole Tesla thing is this. And a lot of these major corporations, what's crazy about Tesla, when you look at the data and stats, Tesla really only make profit because of their tax credits. They make no money off their car sales or anything else. They make all their profit through tax credits, by the federal tax credits and state tax credits they get for people buying their cars.
Well, and that's okay. So in that vein, that might be very well why he's doing that. Like you say, who knows? I don't know nothing about Bitcoin either, but it seems to be just, they probably know this stuff too, right? All these guys with the $100 million companies, they probably knew it before we knew it and are planning for it. And that's why we're doing this today, is we just want the small investor, the small business to have some insight on this. Because it always seems like the small businesses, small investors get the short end of the stick, whether it's Republican, whether it's Democrat. It just seemed like the big businesses always get the benefit. Now, from what you're saying, big businesses are going to have to pay some, stuff as well. But it seems like there's always a loophole. And I just think if we are small business folks and investors, we can figure out how to navigate through this, situation, this difficult situation for sure. I think, we can all do better. But I just, I was inquiring about the stock market just because with that amount of taxes possibly in gross taxes, and also, with the corporate tax rate going up, it's got to have some sort of effect. Well, I ain't gonna say it's got to, right? Because we're seeing in the stock market now doesn't really make a lot of sense based on companies' financials. But I don't even think do they even look at companies' financials, anymore?
It's funny, man. Yesterday, this guy on CNBC, he talked about it great. He said it reminds me a lot about 2000, where people was investing in any .com business
Yep.
out there. What we're seeing right now is in this such a low interest rate market, free credit market, free credit out there, and deregulation that we have switched. The stock market is broken and it turned into a casino where all of the fundamentals are there's no more fundamentals into it.
Right.
And what you're seeing is people are trying to get as much money as possible, and hoping they can get out of it before the market goes down. We don't know when the market's going to go down, but fundamentals will tell you the market is supposed to go down, but it hasn't. So people are eager. Credit markets are easy. There's no regulation, and at the same time, the bonds and interest rates are so low where you have pension
Yeah.
plans and everything else are trying to get in, and trying to get very aggressive. Right now, I was reading an article this morning about how Salesforce are talking about going remote and how many companies in San Francisco are going remote and not coming back. That's going to be a huge issue for these pension plans who are probably invested in so many of these buildings, these commercial real estate, these big commercial real estate. So how are they going to keep the yield? They're chasing yields because they can't get the yields on because of remote workers. People are not going back to work. It's crazy. So you
Well, man, hopefully, talk about Salesforce. They just built that giant tower in San Francisco, which is my favorite building. I'm into the skyscrapers. Living in Oakland Hills, so I had an opportunity to see that one getting built. The skyline changed, and it's my favorite building. I hope they don't. I hope they don't go all the way remote on that one, man, because that is a landmark. I love it. And but here's the thing. Talking about this with my team, we have figured out as entrepreneurs, business people, how to do more things virtually than ever before, and of course, there's going to be a need for physical interaction and maybe office space. But if you can do what you were doing before more efficiently virtually, you're probably going to be saving a lot of money. So I think entrepreneurs and businesses, especially if they're looking at paying more taxes, are going to be taking that into account. And in the commercial, you said something about interest rates. We got two worlds in real estate. We got residential world, we got commercial world. And there's probably a million different worlds within both of those worlds, but just residential and commercial. Residential real estate still going through the roof. Even here in the Bay Area, we got a bunch of people moving out. But it has to go with those low interest rates that you're talking about. Meanwhile, commercial real estate is a different situation. Rents are down in San Francisco for commercials 20-30%. Apartment buildings that are down 20-30%. Vacancies that are all, like almost all-time highs in San Francisco, downtown Oakland. So it's a different story in the world of commercial versus residential. And I think the residential market reminds me of 2006, 2007. So in those days, y'all, like for instance, residential, the default started stacking up in 2006. You started to see short sales all around. Nobody paid attention to it. In spring 2007 is when a bunch of the banks went out of the residential banks went out of business at the same time. Now you start seeing prices for residential stagnant, a lot more short sale. We start seeing these things they call REO, bank-owned properties, which we hadn't seen forever. Meanwhile, commercial real estate, 2007, continued to roll. It was strong. It was hard. We didn't even see any issues. And in 2008, beginning 2008, no problem. Summer 2008 started to slow. And I was just looking at my own deal flow. Summer 2008, it was some okay, and you start seeing a lot of residential REOs. You start seeing a lot of residential short sales because it was already the problem was 2 or 3 years in the making. And when October 2008 came around, when the stock market, when AIG was tripping, Lehman Brothers and them went out of business, and then the stock market dropped 777. Then everything hit the fan. You know what I'm saying? And so this time for residential reminds me of 2006, 2007, because it's just the fundamentals out there are saying, wait a minute, but the prices, it's just still going up. Meanwhile, in commercial, it's a little bit different. It's a little bit different. We're having to fight hard to get loans. Rents are down, prices haven't crashed, but it's definitely a lot tougher. In residential, people still get multiple offers. So very interesting. And then you mentioned the stock market kind of going back to the .com. Kind of feels like that, right? So, man, we got to make some wise decisions out here. All right, we got to make some wise decisions.
Yeah, very wise. Yeah, all this stuff makes no sense, man. the fundamental books, your Warren Buffett investment book right now got thrown out the window. And
Well, but you know what though? Like on that note, right? It would seem like it would seem like that doesn't like make sense, right? Based on the cost. However, everything that glitter ain't gold, right? We know this. If you lived through the Great Recession, if you lived through the dot-com, if you lived through the saving and loan crisis, then you know that everything that when it's rolling like this has a time, has a rise, and it has a fall. And I think if you stay disciplined to the financials, you know what I'm saying, and disciplined to the fundamentals, there's gonna be some opportunities coming your way. And I think certainly for real estate, you know what I mean?
I think it's going to be in real estate. I can see in the stock market. I can see as long as your fundamentals are correct.
Right.
If you get caught up in the mix of crazy investing, I'm just buying just to buy. I'm just moving just to move without a found strategy and looking and doing your SWOT analysis of what's going to happen. You could be truly messed up. And I think we're right now. Our government is pretty much like crazy and kicking the can on these moratoriums, these evictions. People say now we got something in China in 08. I remember they were talking about zombie banks and zombie banks. But now you're hearing hints in America about zombie businesses. We have businesses like GameStop was just one of them, AMC, and a bunch of other companies who have negative cash flow, who are only surviving because of the existence of free money. And
yeah, you're right. Free money.
And it cannot last forever, which is crazy. When we talk about the Salesforce, you said Salesforce actually don't own that building in San Francisco. It's Boston Properties. Boston Properties own the Salesforce Tower. So it's a good thing. You should look at that company, see what they're doing. So it's very interesting in times.
Did they occupy the space? Did they occupy the space there?
Salesforce occupied the space, but Boston Properties is actually the company who's a landlord for that property.
Makes sense. It makes sense. But I just hope they gotta keep somebody in there. That building needs to continue, man. That's a great building. I love that building. So
now, what you're seeing is corporations are on the commercial side and businesses are subleasing their spaces right now, and they're subleasing a lot. So right now, Uber is subleasing 300,000 square feet of its new $1 million foot campus right now. Old Navy is in San Francisco. Yelp is trying to subleasing 161,000 square feet in San Francisco. Oracle is subleasing four other five floors on the 21th tower on Samsung Street. You have the same thing with Dropbox after they laid off 11% of the workforce. That is doing right now. You see with Charles Schwab, you see with Twitter, you have Macy's doing it. So you're seeing a lot of subleasing right now on these businesses in San Francisco, which is crazy.
Yeah. I mean, you never think a major corporation need to sublease, right? But that's where we at, and that's why we got to have these conversations, man, because like we know there's gonna be some more tax increase. Like we know it's coming, and I think we got to prepare for it, man. I mean, whether you for or against it really don't matter at this point because it's coming. Like, you know what I'm saying? And, you got to be able to build your, your plan to keep that into account. You know what I mean? I think it's safe to say that nobody, whatever side of the aisle you're on, if you own a business or you own properties, you ain't trying to pay more money in taxes. However, it is what it is, man. And look, we do have a lot of debt that you said it, they can't just keep printing money, right? At some point, the revenue's got to come in from somebody. It's got to come in more. So unfortunately, that's us, the taxpayer. Now, as savvy investors and business owners, there's always a way to navigate through it. At least put yourself in the best tax advantage position as possible. And that's what I think. As we're sitting here talking, you had some great gems, man. Talk about life insurance. And I'm a real big believer in life insurance for a lot of different reasons, but you mentioned, hit the nail on the head, using that potentially as a liquidity tool. Obviously, as an estate planning tool, possibly as a liquidity tool if you need to get into something. Talk about S corps, and using those in terms of minimizing some tax liability. And we were talking about here, I mentioned, hey, can you exchange? And I'm sure Speaking of exchanges and 1031, I'm sure they're probably talking about that because every time there's a tax change, that always comes up. I just think, man, the 1031 exchange is so productive in terms of revenue, moving money around to everyone. I would hate to see them minimize 1030 or eliminate 1031 exchanges. I know all the real estate groups of the world are going to be advocating against that. And real estate is such a big part of our economy. And, in the commercial real estate, we're already seeing a lot of pain. So I hope and pray that they do not eliminate this 1031 exchange. Is that something that they're even considering or talking about?
No, it's not something that I seen Biden should talk about. The last real big thing he has talked about was lowering the state taxes. So currently, right now, you have a state taxes of what, $10 million right now per individual. So a couple is about $20 million. They're decreasing it to 3.5%, and it'd be 45% is the state taxes. So they're decreasing the state tax exemption to 3.5 with a top tax rate of 45%, and decreasing the lifetime exemption amount to 1 million with a top tax rate of 45%. And any appreciation in assets will be taxed at death, regardless of whether the asset is sold. Let me say again: any appreciation in assets will be taxed at death, regardless of the asset sold. That's crazy. When you think,
so that's when even if you don't sell it, you got to pay it. You got to pay that.
Right. Definitely. And there are some tax credits as well that they're talking about. One, expanding the child tax credit. So it currently tops at $2,000 right now. They'll increase that to $3,600 per child. So that's one thing. They're talking about expanding child dependent care credit, which they expand that maximum credit for $8,000 for one child and $16,000 for 2 or more children, from its current value of $3,000. They're talking about a new $5,000 credit for informal caregivers. So now you can pay for grandmother, your wife staying at home, or any family member or loved one who doesn't work and who's unpaid. Might be a $5,000 tax credit for informal caregiver. You're talking about homes. They're talking about a new credit of up to $15,000 for first-time home buyers to have a $15,000 tax credit.
That'd be good. That'd be real good.
Right. And they're talking about
they need to throw something in there for these commercial property owners. They're gonna need some help. As we're talking about these relet, but neither here nor there. But that's probably a lot of these, and it's the big corporations who can probably figure it out. It's the smaller mom and pop owners that probably the ones who are gonna get hit the hardest, man. Unfortunately.
Right, and the last big one, tax credit for landlords to look out for is there's a renter credit to reduce rent and utilities to 30% for incomes for 30% of income for low income taxpayers. So renters are also going to have a tax, but for landlords, there's nothing. Sorry.
It's not right, and that's why a lot of landlords in California is up in arms on a lot of different things right now. A lot of people feel like they can't catch a break. I will say this though, there's always a silver lining. I know a lot of landlords they got their tenants paying rent. They got their buildings up and running. They're weathering the storm, and there's always a light at the end of the tunnel. But we do need to figure out. We need to have some plans, you guys, especially in the state of California, because the laws are tough, the taxes are tough. Taxes probably gonna get tougher. There's no. I don't know what the end in sight is with the eviction moratoriums, and meanwhile the lenders are not really, a lot of lenders are not, filing default. Banks aren't as of yet. We're slowly but surely seeing commercial lenders like hard money lenders filing default, but the banks aren't. The banks are trying to work things out with their borrowers, and I hope that they do, because there's a lot of great landlords out there that are struggling. It's a lot of and look, if you're a landlord who don't got your stuff together, you need to get your stuff together. I mean, this is the time to get your house in order, get your LLCs, get your court escrow, however you're doing it, get your tax plan together, and prepare to weather the storm. It may not be that difficult, but it's already difficult for a lot of us out here. So it's a matter of just getting the right information and tooling up, man, and making a plan, right? Because as always, if you're an entrepreneur, and we all are, if you're an investor or business owner, you're an entrepreneur, and you need to figure out how to navigate through tough situations. That's what makes us who we are, right? So I mean, this has been great, bro. You know, I appreciate it. I mean, every time we do something like this, I'm sitting here learning, you know what I mean? Myself, man, and I'm hoping that you guys are taking notes and are listening. And just as we getting ready to wrap up, Jay, there's a couple questions I think in the chat. Any final thoughts or things that are on your mind in terms of guidance of how we navigate or operate through this now?
I think just I say don't put. I think during these times, a lot of times we put our head in the sand and be our own island. And if you read the 48 Laws of Power by Robert Greene, he said the worst thing you could do is put your head in the sand and be your own island. Make sure you stay connected. Talk to your associate, your trade associations, your real estate association. If you have a business, your business and trade association. Work, see who the lobbyists are, the political action committees to push, persuade, and they should be working for your best interest during this period of time, and just make sure you have your team working for you and you're working with your team, and just stay informed during this period of time, which is I think is huge.
Yeah, man. You know, and you said something that said, "Don't put your head in the sand." And I think we all could probably relate to that at one point in time. Let's say a challenge happens or loss. Like for instance, I'm sure everybody on the Kansas City Chiefs team right now feel like putting their head in the sand. You know what I mean? Man, what an embarrassing game, right? But these guys are some of the best athletes in the world, man, and that's not going to help, right? Putting your head in it, you got to push forward. You got to move on. And we've all been there. I think everybody listen to this, you can look at one situation and circumstance in your life, your childhood, or whatever, your business career, that is like, oh man, you just want to hide from the world, put your head in the sand, or worse, even worse, I think, start pointing and blaming all the government, the Democrats, this and that, the Republicans, this and that. You know what I'm saying? And I think we see a lot of people that's always going to be complaining about this or that, right? Putting your hand in the sand. Just let's have a better reaction to, you know, adversity. And I think that we look, y'all, when they come out and talk about, hey, we're giving you all this money for free. Here go to PPP loan. You don't have to pay it back. Here go to idle loans. Here go to this extra money. All the extra EDD money. It has a cost. And I know a lot of people not thinking about that. You know what I mean? Right? I mean, you see, you know, especially, hey, look, people on Instagram balling out. You know, businesses, a lot of, hey, I got this idle loan, you know. But we got to count the costs. And it's not like what you said. It's not the end of the world. It's a matter of that figuring out a way through it. For the Kansas City Chiefs, for that, they just got destroyed, right? You know what I mean? Patrick Mahomes, I still think the best quarterback out there, but look, man, they took a major loss. They took that's one of those that cut you to the soul, you know what I mean? Right? But they just got to get up and keep going, you know what I mean?
Right.
And
Look at Andy Reid that Friday. Look at what happened to his son that Friday, and he still showed up. Like we give the Chiefs a hard time, but imagine his son got a car accident. He was drinking, he had a DUI, got a major car accident, hurt two children. I think one is still on life support, and he still had to show up. So his mind might
have to show up to that. And I know he was probably upset with his son, and that's something that, you know, is probably was on his mind, right, in the game. Right. So it just it's one of those things, y'all, is that, hey, we got some taxes coming. You know, we got some taxes coming. You know, and I even think even if it was Republicans probably still in there, at some point, you can't put out all this money and not have a cost for it. Like it just, you know, it just don't work like that.
Do you realize we printed, and you're so right, and Steve, also what's crazy, I'm sorry to interrupt you, is that we printed a quarter of all the money that ever been printed in America last year.
You saying for the whole history of the United States?
History of the United States. A quarter of all the money that ever been printed in the United States history. Back to
so it's a cost for that. Like it's a cost for that. Like whether it's tax, let's say it is no taxes. It's a cost for that. You know what I mean? And that's the thing I like. You know, I'm telling people in the residential world, a lot of people just, oh, the prices are up, multiple offers. I'm telling folks like, look, you know what I mean? You need to be aware of what's all the way going on. You know what I'm saying? Because like we want to, you know, get properties sold, right? That's our job, that's our business. Let's do it in a way that's efficient, and let's do it in a way that where we're giving guidance and leadership to our people, our community, our clients, you know, our business associates, because a quarter of all the money of the United States history had just got printed in 1 year. Correct. And it looked like it looked like they're getting ready to print some more, and they're probably gonna have to keep this thing going. So, so therefore, y'all, we're gonna probably get hit with some more taxes. Let's have a plan in place. I think what I was saying closing is have your team together, man. You need to have a good accountant, and not just an H&R. If you're in business, if you own multiple properties, it ain't just H&R Block. You need a CPA, a certified public accountant. You need to have a financial advisor like Jason Matthews. You need to have an attorney, an estate attorney, or an attorney if we're setting up the proper LLCs, the proper S corps, just the proper structures, of your trust and all these types of things. You need to have insurances. You need to own some real estate too, the right way though. Don't go out there and just buy real estate. I got to buy some real estate. You need to buy real estate and you need to be wise about it because we might be going through some tough times. And if not, fantastic, but you still need to be wise about it. So that's what we all about, man. I really appreciate the time. We got in the chat more of a couple. Jackie Driver Williams says, thank you, Steve and Jason, for this great session. Love it. Brian, he's talking about from the 48 Laws of Power. Law 18, do not build fortresses to protect yourself. Isolation is dangerous. Real talk. And isolation, we in this coronavirus, find a way to link in and tap in with your network, man. Your network is your net worth. Tap in, connect. That's what we're here for. If you're looking for, financial advisor, you need to be talking to Jason Matthews. You're looking to do some business in the commercial investment real estate space, holla at your boy, book an appointment. I think that's all we got. I don't see any other questions or comments. Brian G says, this is great content. Thank you, Brian G. Much appreciated. And we're going to keep the content rolling, man, as always, man. And I wish you guys the best of success. And let's take this information and let's go and let's push forward our investment plans. Let's push forward our portfolios. Let's put forward our businesses. Let's push forward our communities and our families. That being said, Jay, it's always a pleasure having you on, bro.
Definitely, man. I definitely appreciate being on this call.
As always, man. We're gonna wrap it up there. Wish y'all the best of success. Peace out till next time.
Bye, everyone.